Well, Dan, people are coming in pretty quickly here, so why don't you get started with the introductory slides?
Sure thing. Good afternoon, everyone. My name is Dan Toll. I My background is roughly 25 years in commercial lending at this point. I have most recently come off a 4-year term as a contractor for the SBA, working first on the PPP program and then on the 504 program, which is the SBA's second largest guarantee program. I'm currently continuing to work as a consultant, largely for borrowers, and then I'm also doing some underwriting on a contract basis for entities that are submitting applications to the SBA. So it's fun because it keeps me close to the small business action. Why don't we start going through the introductory slides here? And I understand our audience might be larger than the Cleveland area. So if so, apologies for the Northeast Ohio centric references, but we're for one and all wherever you are. So again, SCORE is, I would imagine many of you are familiar, a free volunteer network of folks that have competencies and experience in various arenas. And we're here to help you, whatever your stage of your business is in. I understand that this is largely startup oriented, but from a SCORE standpoint, we're happy to help you wherever you are in your journey. Our mission, much like we're a partner with the SBA, and our mission, much like theirs, is to continue to foster small business growth and prosperity in the economy overall. And we do that by helping you, one person or one business at a time. We are for everyone. We leave no one behind. So anybody and everybody that wants to reach out and seek some guidance, we're here. Just a quick reference to Cleveland SCORE. We are very pleased that we're able to assist with new business creation and job creation. It's very fulfilling for all of us. Just so you're aware, just to remind you, essentially we have a code of ethics that we sign off on. Most importantly, any and all information that you share with us is confidential and remains so. And of course, we have, through the generous donations and contributions of our partners, we are free. So again, please reach out if you'd like to. This I'll just use an example. If you want to reach out and get a mentor, for every chapter across the country and in the national SCORE.org site, there is an ability to select what you're interested in, what kind of assistance you're looking for. And when you do that, when you request a mentor or find a mentor, the screen will populate with folks that have expertise in what you are seeking. This is the fifth seminar in a continuum, and it's the final one of the Simple Steps program to starting a business. So we're focusing on funding sources today. Quick read over of the agenda, just talk in general about equity and debt funding and typical sources of those, and then walk through what the loan approval process is like within a bank or a credit union, how your loan is evaluated, and we characterize that in terms of the 5 C's, which, if you haven't heard of before, is an acronym for kind of the bases upon which your loan will be evaluated. That saying's been around for a long time, but they still accurately capture the basic idea of the factors that come into consideration. And then I just end with a couple of references or recommendations for steps that you might take if you are looking to start a business. First, let's talk about equity in general. I remember before I became more financially conversant, that I always used to say, well, I'd hear people say, I got equity in this, I got equity in that. What's equity? Well, at the startup level, in part, it's the money that you contribute out of your own pocket to get your business started. And whether that's you are 100% funding your business out of your pocket, or 25% with the rest coming from a bank, that 25% is your equity. And then from an accounting standpoint, over time, as you make additional investments in the business in the form of equipment or what have you, supplies, the whole deal, inventory, then equity goes up. It also goes up when you realize profits. And then it diminishes if you experience a loss from the income statement standpoint, or if you take money out of the business in the form of dividends. As I mentioned, it also includes sort of in-kind contributions, meaning that if you own equipment or real estate or any other asset that you contribute to your business, that's also a form of equity. And importantly, the SBA recognizes that as a form of equity as well. So if you are building to the standpoint where you want to seek an SBA loan, please make sure that you literally keep the receipts of your expenditures, whether it's for equipment, really whatever it is, because then that can count towards your equity contribution when the time comes. The nice thing about equity is that you can get more people to join you. And that's great because it reduces the amount of funds that you need, certainly at the startup phase. The obvious detriment to that is that you share ownership, and that often means that there are other voices that have a voice in how your business runs. So it's a cost benefit type situation, and really what works best is whatever you think works best, or whatever gets it done. Different types of equity, just in general, people will use savings, loans against 401k, home equity loans, draw on personal credit cards. There's all manner of which one can, you look at their personal resources and contribute to the business. Very often, friends and family are sources of startup money and beyond. And that's very common, not available for everyone, but it's a common source. Other times people can look to professional contacts that they have, maybe folks that they worked with at a prior business with whom you have a relationship, and then you reach out to them and say, hey, would you be interested in stepping into my business here? So that's very common. Another source is called crowdfunding, which you may be familiar with. Crowdfunding started as a way to bring so-called democratizing both access to capital and investment in capital. So with respect to the latter, I'm a member, quote unquote, meaning that I have an account on a number of crowdfunding sites, because it allows me to see the types of companies that are raising equity or debt via that means. And for as little as $100, you can invest in one of these companies. And so it democratizes. So it's not just the big investors that get to invest in private companies. It allows folks like you and me to invest in private companies if we so desire. And that's growing as a source. I see it more on the debt side than the equity side at this point, but it's still, essentially the process is you put what is essentially your business plan or a synopsis thereof with some financials or projected financials out there, identify how much money you'd like to raise, and then over the next 60-day period, that information that you put out there will be available to solicit investors' interest, so that when you get to the conclusion of the 60-day period, if you were looking for 50 and you got 50, great. If you were looking for 50 and you got 30, that's okay, but that's what you get. It only is open for a certain window, but it is accessible. It is a regulated environment now, so that just to make sure it offers protections both to the investors and the folks that are seeking capital. But it just means there are formal, you will see the documents that if you were investing in a business, you will see the documents that you will receive in the form of promissory notes, et cetera. And that's true, obviously, for the issuer as well. And I mentioned venture capital here. Venture capital and so-called angel investors, which are folks who are wealthy individuals that may or may not still be engaged in their primary business, but are still looking to invest in businesses. These are, you'll hear about venture capital in the media if you're not already more familiar than that. They target the Amazons of the world when they are at an infancy stage, something that has a high, the venture capitalists believe have a high potential for growth, and therefore an opportunity to cash in big as a multiple of what they've invested. Tends to be tech oriented in general, but not exclusively. But these are not folks that are really interested in the kind of Main Street businesses that banks finance all the time and the folks that we talk to at SCORE. But I just mention it because they are part of the universe. Talking about debt in general, kind of three concepts I want to get across here. The first point is that when we talk about these sources, and you'll see what I mean, because there are some like banks, which are generally the lowest cost you can find. There are others which are very expensive and look, like, oh boy, I wouldn't want to have to do that. But really, it's important to be completely indifferent or agnostic as to what source you use. It's a function of what means you have at the time that you are seeking to start a business, and what your circumstances are. I mean, is it worth it to take out a business credit card, advance on a business credit card loan where the interest rate is effectively 30%? Gee, that's pretty high. But if drawing on that line allows you to get started and get your first customer, that may well be worth it. Sacrificing that additional expense may well be worth it, because one customer can lead to two. You start getting the word of mouth out there, et cetera. It may be the ideal in the end source for you if you can't get access to bank funding. So there is a wide array out there, and given whatever your circumstances are, there's a fit. It may or may not be attractive with respect to your risk tolerance, but there's there is a bit of, if there's a will, there's a way. Second point is that what determines the terms and the pricing of these different debt instruments is a function of how much information is taken in by the provider. Okay, so we're mentioning credit cards. Let's talk about credit cards. When you think about what you do when you apply for a credit card, you're putting in your social security number, your credit score is going to be looked at. There's very little information. They may ask about what your income is, who your employer is, but there's very little information. And then you pops out and you get $2,500 or $5,000 that you're able to spend. I think the reason why that is more expensive than a bank loan is because that's all the information they're taking in. They're not getting anything else. They don't know anything else about what you do, for a living. If you're going to change jobs, they don't know anything about your surrounding personal circumstances. There's very little information intake. So for credit cards, the reason they charge potentially such a high interest rate if you're not paying regularly every month is that they have to account for the losses that they know they're going to experience, because they aren't gathering a lot of information. And if you compare that to a bank at the other end of the spectrum, where you're going to submit an application, you're going to submit a business plan, there's a lot of information in addition to just your credit score. They're learning about your business, very specifically, looking at forecasts, all of this information. That's what enables, even when banks are supporting startups, which they do mostly with the backing of an SBA guarantee. But even in those circumstances, mean, the rates can end up being 8, 9%. I mean, over a very long period of time. And the reason for that differential is the information, how much information the credit provider has. And the third point is that ideally, I mean, in an ideal world, the more debt that you can put on your business, the better, with some caveats, okay? But I mean, in general, it's better because the debt providers, even if it's 30%, their interest rate, their return is capped, okay? You as the equity holder, you get all the appreciation of your business in terms of its value and cash flow. A debt provider is only entitled to that slice of it, and that's contractually agreed to at the outset. So you'll hear about people talking about levering up, and it's mostly to, by doing so, you increase the return on your equity. You also have to give some of your cash flow away, but the returns can get very high. Now, the key there is managing the degree of leverage or the degree of debt that you have versus the risk of financial distress. That's the difference. So you've got to, it's not even necessarily a fine line. You generally want to stay away from that line, and lenders will help you do that. But that's the reason that debt in general, you'll hear about people leveraging their returns. That's what they're doing. The other benefit of debt is that you don't have to surrender any ownership compared to equity to continue while you continue operating. Again, the reach of the debt holder is limited. The difference, though, is every 30 days you've got a payment to make, and and that would not be required in an equity scenario. So talking about debt sources, and I'm talking, here are some of these, and I'm kind of going from more costly to least costly. But so we're talking about business credit cards, and they may have, there's a range of them. They will have a range of terms of conditions. So I can't, unfortunately, possibly encapsulate all of that. But again, it's going to be largely based on your credit score, but also they'll sometimes require for a business credit card a personal guarantee, or they might even require some collateral that they put a lien on the assets of your business. But again, it just depends on the situation whether that's appetizing or not. There are also a number of online lenders, and I've cited a few here, where literally you can go online and as they say, in seconds, they'll let you know whether you have whether you have approval to get a loan or not. And again, it's only a matter of seconds because they're not taking in very much information. So it's going to be more costly. The repayment schedules can be weekly, sometimes even daily, depending on what the scenario is. But again, it's a matter of what makes it work for you to get started. If it's not bank debt, it may be worth your while, depending on your druthers, to try something like this to get enough of a track record where you can transition to bank funding. Similarly, there's lender marketplaces like Lendio is the one that I'm familiar with. They're up to 75 different lenders. So when you go into that website and submit your information, that will go out to 75 lenders. And what the information comes back is offers to loan you money. Again, the attractiveness, because they're not getting a lot of information, the attractiveness may vary, but it is another source. Now, one thing I've noticed with online lenders and lender marketplaces, even since I've been doing this presentation, is that they're starting to tilt a little bit more towards having business that have been in existence for, say, at least 6 months. So it might not exclusively, but more and more are doing that. So it may not be a fit along those lines, but I do want to mention it. We talked about crowdfunding. Again, you can do this with respect to debt. And there are really interesting businesses that seek funding on there. Every time I do one of these presentations, I take a look at Honeycomb, which is based in Pittsburgh here, and they've presented to SCORE here in Cleveland as well about their capability. I take a look at what the market, what offerings are out there. And one that I saw this morning is called the Santa Fe Goat Guys, okay? And what they do is their offering sounds very sophisticated. organic, non-chemical way of, ridding areas of, weeds and invasive species. And so that's their pitch. And they also, because it's in the Southwest, where in general there's a higher risk of wildfires. That's also part of their pitch, that they can eliminate that. And how do they do that? In their words, 40 hardy Spanish goats. So in that particular business, I'm not as much interested in meeting with management as I am the employees. But I thought that was a really interesting kind of business. They were looking for $55,000 and they got it. So have to see follow up on how that goes. Three different types of financing here, which can ease the cash burden as you start. First of all, invoice financing. That's when you find a lender, or a lender finds you and offers to, if you get your first invoice, and cash is king, never more than when you are starting out. So you want to conserve your cash, you want to get it as soon as possible too. What will happen is, let's say you want to do it for $100,000. You got a $100,000 invoice from your first business customer, and you don't want to wait 30 days to get it because they're their first customer and you need to keep feeding the mill. So what a lender will come in and do is say, they'll give you 90% of that. And then they'll say, but we're going to charge you 2% a week, okay, on the balance. So say, for example, in the $100,000 example, so let's say the customer pays in 2 weeks. You, the business, collect that money, and then you owe the lender the 90,000 plus the 4,000 that's accrued over 2 weeks, okay? And then you keep the 6. So it actually sounds pretty good. It actually, from an annual percentage rate, which you see all the time, it's about 53%. But it's expensive, but on paper, but you're getting your money. And it helps you not only fulfill that order if you need some additional inventory or whatever. I mean, it helps you get going, and it helps you preserve and get liquidity. Factoring is the same thing, except instead of a lender lending against your invoice, they buy it. And they do so because they're looking at the credit profile of your customer, not yours as a startup. So they'll say, for example, let's say, if it was Coca-Cola, they might buy that receivable from you, that invoice from you, for 90 cents on the dollar. For maybe a lesser strong credit than a Fortune 500 company, it may be 80 or 85 cents. But again, you're getting that cash within a couple of days, and they're responsible for the collection. So you take your cash and you're on to the next thing. And I want to mention equipment leasing, and the same goes for real estate leasing. If you want, again, in the name of preserving liquidity, you want to keep as much cash on hand as you can, particularly at the outset. And equipment leasing, or renting property, allows you to do that. You contract for a period, you make a commitment, you contract to pay a certain portion of what would otherwise be a purchase price, a full purchase price, over a period of time. But that's over a period of time. And any payments you can push back into the future, the better. So I would recommend leasing. I have seen people try to buy property out, or go ahead and buy property in anticipation of starting a business. And again, it all depends on their personal circumstances. If there's someone who has a lot of financial wherewithal, maybe that's okay. But I've seen people do it where that's not necessarily the case. And it really puts you behind the 8 ball before you ever get out of the gate. If you need real estate to get started. Stepping into the lending world, there are a number of what are so-called mission-oriented lenders that are in the community, and they are just that. They are chartered. They're typically nonprofit. They are chartered to make sure that all members of the community, underserved populations, as well as folks that traditionally have not had anything to worry about in terms of access to capital, they are there to make sure that everybody gets an equal chance. So and I'll bring up the first one here, ECDI, which is the Economic Community and Development Institute. It's based in Columbus, has offices in Cincinnati and Cleveland. They are very resourceful when it comes to finding small loan amounts, larger loan amounts. They utilize SBA-backed platforms, and they also get money from local banks who get a excuse me, sorry about that. They get a tax deduction for contributing. But what happens is, like here in Cleveland, say Huntington and Key Bank will, in general, donate to a fund, okay, that ECDI has. And then ECDI can pull from those funds to make a loan to a business. And again, the lenders are doing it because they get Community Reinvestment Act credit, which is important and necessary for them. And it allows, so I've worked with clients where they actually sign a couple different promissory notes. Like in that instance, you'd end up signing promissory notes to both Key and Huntington, but the only folks that you deal with are ECDI. They're very creative. There are some folks there that I just love. I mean, they think of things and think of things that I can't think of, and that are aware of things like that in the marketplace, where they can find resources to capital that, and I consider myself pretty familiar, but that I haven't even thought of, or there might be something, excuse me, new that's available. HFLA of NEO, it's here in Beechwood. What they do is, if you can demonstrate that you've not been able to get loans conventionally, that you've been turned down, and they'll actually ask you for something that confirms that, they will provide up to $20,000. You have to go through an application process, but they are literally kind of maybe not the lender of last resort, but next resort. So if you weren't able to get money conventionally or even SBA backed, you can go to them, and as they say, their process is very much the same. It's not different from banks and other lenders, but their barriers are lower. You have a lower hurdle to cross. They'll accept lower credit scores and things like that. So important to mention, Growth Capital is the local certified development company here in Cleveland. And they have the ability to do the Community Advantage program which is broadly under the 7A program with SBA. They also work and do under the 504 program. That's a program I'm currently working on and did work with when I was with the SBA. Is for real estate and equipment. So they will form part of what is essentially a joint venture between a bank and the CDC to provide loans to small businesses that are seeking money for those purposes. But they are also a mission-oriented lender in town. Types, again, friends and family, network contacts. One thing I want to mention here is if you do choose to take money, accept money from a friend or family member, please write up a promissory note and and I would specify, how you're going to repay it, at what interest, because it avoids, where you don't want to go wrong with friends and family is if the business go wrong, your relationship goes wrong. So one of the ways that you can mitigate against that is to document it, so the expectations are clear. Obviously, that friend or family member or professional contact is going to know that you are a startup business, but it gives additional comfort. It signals your commitment and intention to repay them, and it has the added benefit of making sure that, enhancing the probability that you and Uncle Joe are still speaking in 3 years. So for real, I mean, I'm not trying to make light of it. We obviously have conventional banks. The large banks, conventional lending, I should say, from the traditional sources, banks, mid-sized banks, small banks, community banks, credit unions, okay, that make loans on a conventional basis, which generally means that that loan isn't getting backstopped by any other entity. There's no other credit enhancement available to them, meaning that if they lend out $1,000, they eat 100% of that $1,000 if the business is unable to succeed, if that's the amount still outstanding. So that's conventional bank financing. It's the lowest priced financing on the market. And again, it's that informational content in the process of the application process that allows them to not only get to know your business on paper, but to get you to know you in person, excuse me, which is very important from a banking standpoint, I believe. So then we have the SBA, and I won't go through all of this, but again, we've talked about the 7A is their largest program. They'll do working capital, they'll do real estate, they'll do equipment. They have a number of different ways that they will backstop loans made by their banking partners, which is essentially, there are a few banks these days that don't have some type of SBA capability. So, and their guarantee, depending on the type of program, can range from 50 to 90%. So it's, getting to the last point here, the SBA is not a direct lender. What they do is by providing that, say, of that $1,000 that Huntington Banks makes a loan to somebody, they're going to take 500 of it if things go bad and you're not able to repay. But by providing that assurance for 50% of the capital, it de-risks the financing enough from the bank standpoint that they'll make the loan. Okay, so what are the requirements to get access to that? It's called the no credit elsewhere test. That's the permission, and it just means that you can, if you need to be able to demonstrate, doggone it, sorry about that. You need to be able to demonstrate that, or in this case, the lender needs to be able to demonstrate that there's no credit elsewhere available to you on terms that are standard for the market that you're in. And when they're talking about that, they're not talking about the online lenders and those kind of folks. They're talking about banks. And I would say that 100% of the time, a startup fits into that category. You're not, unless you have a lot of financial wherewithal and you're essentially getting $1,000 loan and you've got $100,000, tucked away in a savings account. Well, that, when you've got that kind of liquidity, a bank might do something like that. And I've actually seen those loans and been a part of them before in my banking career. It's very rare, but it happens. But in general, absent something like that, a startup's going to meet the no credit elsewhere test because regulated lenders that are lending out our deposits as depositors in these banks, they can't take that kind of risk with the money. So, talking about the loan approval process, it's pretty straightforward. I mean, I think, in general, one comment I want to make is I think if you haven't been engaged with banks from a business standpoint before, so you're starting, you have your personal checking account and these kinds of things, maybe a loan, maybe a mortgage. You have some familiarity with submitting applications and signing documents and whatnot. But when you're starting up a business, there tends to be sort of a level of fear associated with banks in general, not necessarily specifically. It's just there's this, number one, because they control the outcome, right? When you go to them, you can do your best selling job, and I encourage you to do that. And we'll talk about that, but it's still in their hands. And plus, it can seem kind of mysterious. I mean, a bank takes in your application and say, okay, we'll get back to you in the next 2 weeks. And then, maybe someone calls a week after that and says, I've got a few questions. And then it's like, okay, thank you very much. And it's kind of, okay, what's behind door number 3? You're not really sure what's going on. So there is that element of fear and uncertainty that occurs with the process. And part of me giving these presentations, I'm here to mitigate that. I want to eliminate that. And that's in part by describing this process. So you submit your business plan. You'll submit your personal tax returns for the last 3 years. As a startup business, you won't have tax returns yet, or if you're an existing business, you would provide tax return data as well. And then you're going to provide either historical financials if you're an existing business, or a projection of what you expect your financial performance to be. And if it's for the SBA, that's typically 2 years. The first year is monthly projection. The second year can be an annual. Okay. And, if you have any questions about how to prepare those, we're here to help you for sure. But there are various templates out there that you can use to create this. And basically, the most important part of that exercise is developing the assumptions, because the numbers are one thing, but looking at numbers independent of assumptions, especially for a startup, doesn't provide much value. So you want to say, here's what these numbers mean. They mean 10 customers at $5 a piece for 3 months, or whatever it is, and it's I'm selling them 20 widgets at $2 a piece. So this is what my expected profit margin is. It's those kinds of assumptions that you want to layer in. And one thing with business plans, and I know the simple step process talks a lot about this, so I won't go into that overly here, but make sure you include hard data, third-party data in your plan, meaning that your business plan, it's best that it not consist of assertions made by you about what kind of market is out there for, what you're intending to do, and what kinds of, customers you'll get, without any third-party information to validate that, because it's otherwise just you validating you. And that's kind of a bubble that people are in, and you need to get the outside data. So what's an example of that? There's a term out there that you see in the startup world, even in the venture capital world. It's called total addressable market, or TAM. And what that is it's either expressed in the number of potential customers, whether that's businesses or consumers, depending on what your product is, or it's described in dollar value, which is typically that number of customers or businesses that are potential customers of your times an average sale number. So you can say, okay, I'm developing this product, and I think the potential market for this is $10 million. And in this area, based on the demographics that I see, et cetera. And then you're able to cite those. And it's not as hard as you think to find that kind of data. I mean, I live in Solon. So for example, if I was going to start a business here, on the Solon website, they've got the demographics of Solon. And then I can go to Aurora, or, other areas, Bedford, other places that are right adjacent. Say I'm trying to do something that's local, like a restaurant. I can go there and I can get median incomes. I can get, other data. You can even get data, if you really drill down, on how many people go out to get meals versus staying in. There's various levels that you can drill down into. And the more that you can find the data that supports your contention that there is a problem that you are solving with your business, the better chance you're going to have to get a third party interested in investing in you. Identify lenders. That's just what it sounds like. So, and here's my recommendation is, say, for example, you're a startup business. Well, Huntington is a top 10. Huntington Bank here, well, actually based in Columbus, but obviously big in Northeast Ohio, and other states in the region. The idea is, okay, I'll get a Huntington because they're a top 10 SBA lender. They've got delegated approval like a lot of lenders have, which means in the 7(a) program, everything has to be approved by the SBA in the 504 program. In the 7(a) program, there are delegated, so-called delegated lenders or preferred lenders, where they have the ability to approve a loan without having the SBA sign off on it. They have, through a demonstrated history working with the SBA, through the financial stability of the bank, they've demonstrated the SBA that they are a worthy partner in making these decisions for them. So they'll simply just report the approval to the bank. But Huntington's one of those, okay? So Huntington's a large bank, and their process would be from an entry standpoint. These days, for the larger banks, there are no more bank floors. And if you don't know what I mean, I'm dating myself, but if you go back 30, 40 years when I started, I started on a banking floor. It used to be like every bank, especially in a downtown area, you'd walk in and it'd be this big, and it'd be like, real high ceilings and just desks all over the place with personal lenders, banking, commercial lenders on the floor ready to help you. Well, that's gone the way of, cost efficiency these days. And also, the ability to deposit remotely and everything else that's happened. So with Huntington, it's usually where you'll go into a branch and the branch manager will take your application and then submit it into the SBA department, where again, they might reach out and ask you questions. You know what? That's fine. I mean, there's nothing wrong with that process. You might as well take a shot at it because they do so much of it. But then I would hedge my bet with a big bank like Huntington, and I would look at some community banks or credit unions, because with those folks, there is still a semblance of the banking floor. It's still there. You can actually go in and sit across the table and talk about what your business is going to be if you can get the bank's help. It is always, I was a senior credit officer for Wells Fargo, as one of my journeys in banking. And I think people think of like credit officers or whatever, it's kind of people sitting in an office somewhere just looking at pieces of paper and saying, yes, no. The reality is you're not doing the borrower any favors and you're not doing the bank any favors unless you're getting out and meeting the people, especially with startups. Because when you start, you are indivisible from the business at that point. There is nothing that the business has to show for it other than what you've contributed in the form of cash or other assets. So you're going to make it happen. So as the lender, it's in my best interest to get to know you at some level. I recommend doing that. And I recommend trying to get in front of people. And if you can't find the places to do that, I know I can recommend those places. Other SCORE mentors can recommend people to talk to. I highly recommend it. But what I'm talking about in general is don't just go to one bank to start, because then it's like a 2-week or 3-week process and you're just waiting. Go simultaneously to a bunch of banks.
And let me interrupt. There's a question on how long should they plan on for the loan process? And is an SBA loan take longer?
Um, the answer is, is on the 7A part, no, because again, you mostly have delegated lenders approving those. So there's nothing that's going to happen outside the regular, like at Huntington, it's not going to take longer than their regular approval process for other loans. That's one of those questions that really depends based on the bank. I mean, if you have gotten them, once you have gotten them all the information you think they need and they think they need, it shouldn't take more than 2 to 3 weeks. I mean, in my experience, we never let it go that long because we wanted to be responsive to the customer, and I think you if you have to say no to someone as a banker, there's 2 things you want to do, and I am not saying that everybody does it. If you're going to deliver a no, you want to deliver it as quickly as possible. And the second point, from the customer standpoint, just so that they maintain the availability to go, the capacity to go somewhere else. And the second thing you want to do is you want to tell them why, because it does no one any good to say, well, yeah, Oz behind the curtain said no. That's all I can tell you. That's baloney. And I would try not to accept that if I were you. They know why they didn't. And it may have nothing to do with you. It could be an institutional preference. If you're starting a pizza joint, they just may have written off a loan that went bad to a pizza joint, and they may just for at the time being, they just might not have the appetite. And there are those kinds of idiosyncratic preferences across banks, and you don't know what they are. You hope, frankly, that when the optimal thing is when you sit and you're across from the banker, he or she can tell you right then, because there are certain things that they can screen based on their culture, which they know, that can let them know. So go to a bunch of banks, try to get in front of people.
Dan, there's a comment right now. When going to multiple banks, can't that be detrimental to my credit score?
No, I mean, I suppose if they pull your, I mean, it could be, that's true. If they're pulling your personal credit score, um, it could be. Yeah. I mean, that's a good point. Um, I mean, I'm not saying necessarily go to 20. I'm not saying necessarily go to 10, but maybe 5, 4, 5, 3, whatever. I mean, whatever's appropriate, whatever might fit. It's up to you. This is just my recommendation. But also that flips back after 30 days. So that's only a temporary dent on the credit score. It comes back. So and you can pull stuff for free all the time that's got the agency's seal of approval on there. So if it were me, I'd walk in with one. Now they probably have to pull it to validate it, but at least they have an idea, and that's more information to know for them, so that if there is a minimum credit score, and that's not often the case unless it's a specific program under which they are lending, where the criteria are, that have to be adhered to are laid out. And that's not true for SBA backed loans or in general commercial loans, by the way. I haven't been part of an organization that had that kind of situation, or that kind of requirement. But yeah, it will, but it'll bounce back. And also, again, if you need recommendations, mentors here at SCORE we can give people for you to go to. I've got people at ECDI, I've got people at credit unions at other banks, and that's what's called a warm handoff, because I can give that person a call in advance and say, hey, so and so from ABC company is coming in, or ABC startup company is coming in, would like to have a visit with you. That's a warm handoff, so you're not coming in cold. But it doesn't matter as much if you're still getting in front of someone. Okay, I recommend it just because. Let's just say that the people that know me, I'm never going to stop anyone, but I pay people the courtesy of being direct. And I think if the chances aren't high, I will let you know that, and SCORE mentors will let you know that, not to discourage you, but just say at this point in time, given these circumstances or whatever it might be, what we would do is work to improve your chances. But what I'm saying is that people don't usually send people to banks unless they have an idea that, they've got a high chance of working out. Because then the banks don't take their calls very often after that. But again, not to discourage, because to be clear, I or any of us would work with you to absolutely maximize the potential of whatever you're submitting to any bank. Have that meeting if you can get it. Ask questions. Ask about their approval process. You want to know how long it takes? Ask them. And and then say, okay, at the end you say, okay, great. So I'll be hearing from you in 2 weeks. And when you don't hear, call them and make them. You shouldn't have to make it. We never got in a situation. I've never been part of a situation where we weren't responsive enough, but I know that it happened. I do. So sometimes it happens for reasons that are expected. The loan officer looking at it gets sick, or there's somebody who's part of the credit committee is out on vacation. Usually there's a provision, or there's circumstances that allow for the committee to go ahead and handle things, but these things do happen. But in general, they shouldn't. So ask questions. Don't sugarcoat the risk. In fact, I would want you to be articulating the risks of your business to them. Now, the banks are going to come up with their own risks, and that, don't worry about that. And I do that with clients. I'll say, look, you need to identify that these are the risks, and this is how it's mitigated. These are the mitigating factors, because they're doing the exact same thing with internally with their credit memos, which are basically sort of a rewrite of your business plan, except it's oriented towards a bank's point of view. So they're going to say, okay, this is a commodity product, prices can fluctuate, margins can get hurt, blah, blah, blah. I hope you know that going in as well. And we would work to make sure you know that. You're going to know these things about your business. Go ahead and beat them to the punch. It shows that you're aware of their point of view. If they want to, if you want them to step into your shoes and understand your motivations and what you're doing, step into their shoes too. It builds your credibility. And as I say here, I don't know is a perfectly acceptable answer. Nobody knows everything, including the banker sitting across from you, or this one, me, for example. I mean, nobody knows everything. Part of what I love about this business. But say I don't know if you don't know. If you start hedging, you don't want to accidentally, just out of like a moment of panic, try to commit to some fact that isn't actually the case. It's not like you can't correct yourself, but it's just better to say, I don't know. Can I get back to you in 48 hours?
Dan, you got 10 minutes here.
10 minutes. Okay, here we go. Sorry, folks, I always do this. Talk too much. But the approval process, a couple folks will take a look at it, usually the loan officer and an analyst. They'll take a look at your projected financials, or what they call spread them on systems where they can look at the ratios they like to look at. They'll review the information you've submitted. Again, they'll come back if they have any questions. And then they'll sometimes do research of their own. As I mentioned, they'll prepare a credit memo that's like your, essentially a reformulation of your business plan in many ways. And then banks have either one or of two approval processes. Committee processes, where a loan committee meets once or twice a week to, usually consist of, the credit officer, a credit officer, a line, business line manager, the loan officer, and there may be, in that committee process, maybe one person has to sign up, maybe they need a quorum of 2 people or 3 people, whatever the case may be. There's also what's called signature authority, where it's one person you're getting approval from. The great part of that process is, and that's what I operated under most of my career, is that it does just take one person. The downside of that is what I mentioned earlier. If that person's not around, it could cause a little hiccup in the timing, because it's not often that somebody else will be available and will want to step in and approve a loan for another business unit in a bank. It's just a protocol that generally is adhered to. But I worked under both. They both work fine from your standpoint. So they'll communicate the outcome. And as I said, if you don't get a yes, ask. If you do get a yes, you get a term sheet, you'll look at it. You can ask why there's things there. You can ask for certain things. You may not get them. If you want some changes, they'll do their due diligence. So if, for example, you were buying real estate as part of this, there'd be an appraisal and an environmental done, those kind of things. Most important thing here is the process is exactly what I've described. It's exactly that. There's no surprises here. So no mystery, no need to fear it. Embrace it. Loan evaluation, 5 C's. Character, personal, business credit history. People will look at your credit history as, kind of what it is. Do you work to make sure that you satisfy your obligations? Important caveat here. There are people who have declared bankruptcy before that get SBA loans approved every day. Okay? They're not still in bankruptcy. Usually it's a few years in hindsight at that point, but things happen. Divorces happen. Healthcare expenses happen. I mean, for example, in SBA, and let's talk SBA because that's what you're going to be looking at as a startup. If you provide a written, show that proceeding has been, satisfied, to according to terms, and that it's been closed, and you provide, a letter. I see them all the time, and it's often along those lines. I had somebody somebody got my credit card and went rogue, or there are all kinds of circumstances. So there's not, as long as you can adequately explain it. To be truthful, if it's, you're just blowing them off and you don't pay things and you go into bankruptcy, that's not going to be well received. But if it's, an event type thing that, or again, you were sick, credit, health, bills that weren't insured for whatever reason, which happens to a lot of folks, people will understand. So character is mostly repayment history. They'll get clues from marketing, from the marketing, from sitting across from you when they're talking to you. That's part of it. Professional experience, what is your professional experience? How does it relate to what you're proposing to do? And you can provide references if you'd like. And I also recommend providing references from potential customers who just have a letter saying, yeah, if Dan gets ABC business off the ground, I'd be interested in buying product from him. It does matter. Capital, we've talked about it. It's what you contribute to the business, and what you have as a result of getting debt. If you do that, is a so-called capital structure, which is comprised of X% equity and X% debt. And it's one thing that banks monitor so that there's not too much debt relative to too little equity. Capacity. This is the most important thing, SBA. The most important thing is they will look to see that under your projections, you cover your projected debt service requirements under this SBA loan at least it can be 1.15, but I would say generally 1.2 times. So it's not just 1-to-1. My debt service is projected to be a total of 100, and I've got 100 of free cash flow. That's not going to be enough because that's not enough wiggle room because things will fluctuate. But if you can demonstrate 1.2 times coverage and credibly do so in terms of the assumptions for your forecast, that puts you in business. Talked about accrual accounting versus cash accounting. Taxes are typically cash accounting. Accrual accounting is financial statements. EBITDA is a term that you will see a lot with bankers, just to let you know what it is. Collateral, again, what the assets of your business, whatever they are, they will be pledged. And sometimes, just to let you know, if you own a home as a startup, they will often take a second on your home. So just be prepared. It may not happen, doesn't happen in a lot of circumstances, but it's something that folks might do. Conditions just can be the industry, competition can also be just the terms of the loan that's proposed. So in sum, here are my recommended preparatory steps. Wherever you're working, if you're thinking about, starting a business at some point, number one, stay employed as long as possible, because, you want to have, you don't want to, and in general, I recommend starting as a side gig if it's possible, or have someone, like if you're married, if your spouse is working and gets money independent of the risk that's associated with the business that you're proposing to undertake. You don't have to have it, but it does mitigate some risk. But you can always learn things wherever you are, even if it's a completely different business. I mean, when I was a teenager, I started in the ad room of a big ad agency in Chicago. I was in the copy room, but I read all the stuff that went through there. And, just sort of by osmosis, you just learn stuff that wherever you are, and you can learn things, and you will learn things about other areas of the business besides the one you're in. Obviously, build and maintain your personal credit score. I've got resources. I've got a bunch of links here at the back that pertain to things I've spoken about. If you need help with that, you can contact us. There are websites that will help you do that. And obviously, it's just something you want to be mindful of, that if you are trying to get money via whatever means, because again, even those high-priced online lenders will look at your credit score. Be mindful of that and do the best you can to keep things in line. Grow your network. Reach out via LinkedIn to people that are in the industry that, for example, you want to be in. Volunteer, go to trade events that are in that industry, and ask to sit down with people. I've never met anybody that isn't flattered by somebody wanting to learn about a business from them, about their business. They love to talk about their business, just like I'm over talking now. I love to talk about lending. So you can do that. And I would recommend it. It helps give you insight, right? It builds you a community to fall back on once you get started as well. So research. Again, we've got AI. Be careful with ChatGPT. Unfortunately, AI, it's fast, it responds, but it still thinks that fiction can be fun. A lot of stuff that comes out of there isn't necessarily true, so you have to validate it. So it helps. There's no question. It helps you write things and better word things and organize things. But from a pure research, standpoint, there's a little bit of caution flammable associated with that right now. Um, and just grow your knowledge base. If you're like an IT services, information technology services, just something that people do on their own all the time, or start small businesses with. You can get certifications, which help build up your credibility and legitimacy to your customers. I mean, it's almost mandatory in that particular area. But learn as much as you can, and just because it'll help you down the line, try to get a little bit familiar with financial accounting. So you know what income statements look like, you know what balance sheets look like, you know what the categories on there. I found I worked for a financial services company doing business valuations and all this other stuff for 5 years out, my first 5 years out of college. I hadn't taken a single accounting course, and I didn't need to because it was all cash flow based. But I took accounting and I thought, okay, I know I have to take it. I need to learn about this. I ended up majoring in it. There's a lot of logic to it. You may, outside chance, you may actually find it fun. Anyway, I hope you have found this reasonably fun or close there too. And I wish you all well in your future endeavors.
Well, thank you, Dan. It was very, very well presented and educational. While you were talking, I handled probably 6 or 7 questions where I thought I had the capability to handle. Now, if anybody else has a question, raise your hand and we'll allow you to ask Dan directly.
I've beaten them into submission, Bob.
Oh, not sure yet. Here comes, let's see. There's a question about, um, let me read it to you and
Sure.
uh, okay, now, okay, where is it again? Sorry, a lot of questions here. Anyhow, is about getting a line of credit. Can you get a line of credit while you have a loan outstanding?
Like a term loan or something else
Yes.
like that. Absolutely. It's based upon, if you already have a loan, I mean, number one, and it's for your business, I mean, you've demonstrated that you are credit worthy. What uh, what a line of credit is usually for, I mean, you want to make sure that you line up the type of credit facility you're using with the purpose intended. So, for example, real estate. I buy real estate personally, so my house, it's because it's a long-term asset, right? My house is going to hopefully be around for 30 years more, and it's a long-term asset, so it makes sense to repay it over a long period of time because it maintains value. Now, when you talk about a line of credit, you typically don't want to finance those because you're not going to be able to repay that as quickly. It's kind of getting that outstanding under a line of credit will get kind of stranded there. And so the bank's not getting repaid as quickly as they would expect. And you're having to pay interest on the outstanding. So you want to make sure you're matching. And a banker should help, it's in the banker's interest to help you be aware of this as well. But you absolutely can. The typical purpose. So say, for example, I get a term loan to start out with because I bought a bunch of equipment and I want to term it out over 5 years or whatever. But then I get started and I realize that a lot of my customers have terms. So I can't get paid till 30 days out. Well, I have payments to make in the meantime, right? You got to pay. Most people don't want to be paid once a month. And maybe my rent comes due in the middle of the month, the middle of that period. So what lines of credit typically do, but by no means exclusively, is finance short-term assets like inventory and receivables in that case, where there's a timing gap. You need to make payments to people or other vendors before you're going to get collected. and get collected before you collect your money. And so that's typically what that will represent. Sometimes there are lines of credit that get termed out over time because, and I won't get into this because sometimes it can be what's called permanent working capital that sort of gets built into that line. And you kind of recognize it when there's a certain level, the banker does, when there's a certain level of outstandings that just don't get repaid in the ordinary course. And it's not because the borrower wouldn't want to. It's just because they don't have the business doesn't have the capacity to. So maybe you term that out as well, spread those payments over time as long as it's collateralized. The short answer is yes. And usually, if you demonstrate the need, again, it's in the banker's best interest to make sure that happens. And a lot of times, now you can't as a startup always have this leverage, but a lot of times there's that term loan line of credit come hand in hand. Probably not at the startup phase, but not long after that. Once you've got, ideally you've got a bunch of vendors that you can say, hey, yeah, I'll pay you in 30 days. You may not have that leverage either. So those timing gaps will still exist. But yes, you can do that. Oh, and by the way, one last shout out. The other thing about bankers, they are not Dr. No. They want to do business with you. They have to do business with most of you because they have a budget to meet, both individually and collectively. Okay. Because there's this image that, bankers, they'll only loan money to the ones that don't need it. Not true. I mean, right after the 2008 financial crisis, when I was at Wells Fargo, our budget was 15% higher the next year. It doesn't matter. Business goes on. They need to make loans. You just want to try to make you be one of those targets. But they want to make loans to you. Trust me.
Okay, Dan, somebody want to know how to contact you, and I told them to go to our website and choose you as a mentor.
My email's at the back of this too. If anybody, if you got any questions that, you don't necessarily need to hook up for, I'm happy to, you can do that as well.
Great. Well, thank you very much. I think this will end the webinar. And you have a few people who said that they want to contact you, and several people said how wonderful the presentations were. Thanks, Dan.
It's my pleasure. So good luck, everyone, and have a great day, okay?
Take care.
Bye-bye, everybody.